Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on support and resistance. One of the most important concepts that you need to master to trade the markets. Now, for those of you joining us for the first time, ETX is a regulated provider, and I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned are for educational purposes only. And for those of you that are joining us from the internet and don't know anything about ETX, we are a fast-growing financial services company, and we're based in London. You're welcome to come by and see our offices, stop by and say hello, or a lot of times on Sky or CNBC, CNN, you'll see live interviews with our analysts right in our office, so you can see us in the background and wave hello to us. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. We offer many different ways to trade on the platform, starting with our web trader, our ETX Trader Pro, which means you can trade from anywhere at any time very easily. You can customize the charts, you can set up all types of stop orders, and it's the lowest spreads possible. You can also use our advanced MT4 platform, which will allow you to download expert advisors. You can use our advanced charts there also, and you can also build your own automated trading system right there on the MT4 platform. And then lastly, we have our ETX binary, which binary is a great way to enter the markets when you're first starting to learn how to trade, or you can incorporate it into your other trading strategies to offset some trades that you're making. But remember, at ETX, we offer every which way you can trade stocks, commodities, shares, or indices. So if you haven't traded with us before, give us a shot, contact us, and we'll show you exactly how. We'll set you up demo platforms or with our live platforms. Now tonight we're going to be talking about support and resistance. And there are many different ways to get these levels. And there's all different types of support and resistance levels. But they are part of what's called technical analysis. So despite all the fancy and exotic tools it employs, technical analysis really just studies supply and demand in the market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the market by studying the market itself. Now, support and resistance is common jargon for areas on charts where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like price ceilings that price cannot break above. Now, there is no rule, there's no law, there's no guidance. Price can go right through a support or resistance level, or it can bounce off of it. But these levels help us predict where we could expect some type of market action. Because remember, the markets just don't move in a straight direction. They bounce up and down. And these areas of congestion can be sometimes predicted because they happen at support or resistance levels. So knowing where these levels are make it easier to decide when to open and close trades and how we can locate, but how can we locate these to begin with? Now, there are many ways to get support and resistance. My favorite, which we're going to look at tonight, is what I call eyeballing. Back in the old days when I started trading almost 40 years ago, this is the only way we could do this, is by eyeballing. And eyeballing is looking at price charts and finding these areas. But today we also have Fibonacci levels that will give us support and resistance. We have Gann fans, we have pivot points. So there's many different ways to have or get these different support and resistance levels. And you can use many of them. I advise most traders to at least use 3 different methods to give you more information about how price is going to move. Now, support and resistance can have numerous applications and can be identified in a multitude of ways. Traders can use support and resistance identification for managing risk in a strategy. Traders can also use support and resistance to grade market conditions and enter positions. One of the more difficult concepts within technical analysis is grasping the premise of support and resistance. There are numerous ways to identify these levels, and even after identified, there is a plethora of ways of integrating it and trading with them. So one of the best reasons to learn how to read a chart is so that you can properly apply technical analysis. Now, not every trader believes in using technical analysis. Even if it's not your primary method of trading, it is important to understand there are some basics of charts and technical analysis that everybody should be using, okay, no matter what trading system you are. And that is being able to read a chart, put a trend line on charts, being able to read volume and support and resistance. They should be part of every and any trading system you have because they can alert you to what is happening in the markets. Now, lots of you guys are fundamental traders. You trade from news and headlines, press releases. Okay. Well, all this might tell you which direction an asset will go, but very little will tell you where to enter the market, when to exit the market, and where, when an asset is moving, where you could expect some type of action or reaction. Now, support describes a price level that an asset tried to cross below, but ultimately stayed above. Now we're talking about when prices are moving up. When prices are moving down or in a downtrend, it is just the reverse. Remember, for uptrends it's one way, for reverse downtrends it's the exact opposite. Okay? But the rules are the same, they just inverse. Resistance describes a price level that an asset tried to cross above but could not. The bare minimum requirement to draw a support line or resistance line is that an asset must spend a significant amount of time or volume at that price level. That's it. There are no elaborate rules. Specific types of support and resistance can be drawn on additional chart patterns. Defining the concept of support and resistance is fairly simple. When discussing it in the context of, say, the stock market, it defines the level at which buyers and sellers step in a market or where the law of supply and demand comes into play. So let's use a hypothetical story. I'm going to make up a story for you about the good old days. I talk about the good old days all the time. But let's go back a lot of 100 years ago. And we're talking about the Mideast in the United States or the Midwest in the United States when the cattle farmers would actually drive their cattle to the commodities exchange or the cattle exchange, and there'd be an auctioneer selling them off. Okay, so Monday morning the auctioneer comes in. He has to determine where he's going to start his bidding. He talks to the guys who want to sell their herds, and they tell him what price they would like. And he says, well, you know, this is Monday. We had a lot of cattle coming over the weekend. Friday, when we were down to the end of last week's lot, we were getting about 63 cents a head, 63 cents a pound. You know, this morning we have a huge stock. We have a lot of buyers, but we have huge inventory here. So we may not be able to get 63 off the bat, but we'll see where we can start. So they agree to start. The bid is 63. So he gets up and he starts hollering out, I got 63, 63, 63. And he gets no buyers. So he goes down, I got 62.50, 62.50, 62.50, gets no buyers. He says, I got 62, 62, 62, and he gets one or two buyers. Not a lot of anticipation, but one or two buyers. Well, 62 just set a support level. Because 62, we know we're getting buyers. So he's not going to go below 62. He's now going to bounce back up, and he's going to go back to 62.25, 62.25. He gets no buyers. He goes back to 62. He gets one or two buyers. Then he gets nothing. And he goes to, I got 61.95, and he gets a buyer. So he goes back to 62. He gets another buyer. So now he goes to 62.05. He gets another buyer. He goes 62.10. Okay, no buyers. He goes back to 62.05. No buyers. He goes back to 62. He gets a buyer again. Well, what happened is 62 became a very important support level, and we saw multiple times that the price bounced off 62. So now, if you were going to chart this down and you were coming in on Tuesday or Wednesday, and you were going to look at a chart, you would say, okay, 62 is a very informative structural price, a support price. So I'm here to buy cattle. So 62 is a price I want to buy it for or below. Okay, you're a seller. You say, well, 62 is the lowest I'm going to sell for. I'm going to bounce it back up. Okay, now Wednesday comes, half the herds that came in on Monday are gone. The numbers are lower. There's still a lot of buyers, but the weather looks like it's changing, so the buyers want to buy up on Wednesday because they want to be gone before the bad weather comes in. So Wednesday we have a very good day. So they start out at 63, nothing at 63, 62.50, get some buyers because that guy wants to get on the train and get back to Iowa before the bad weather gets in. So he says, okay, I'll buy a 62.50. So the auctioneer goes 62 from 62.50 to 62.55, gets no buyers, goes down to 62.50, no buyers again, 62.45. Okay. Goes all the way back to 62.05, he gets a buyer. Goes to 62, and all these antsy guys start buying because they say, this is the support level, we're not going to get below that. Okay. So this is where they actually come from. Supply and demand and the buyers in the markets and the sellers in the market based on other factors out there. Okay. And in order to ascertain how important a level is how much time did the price spend at that level and what are the market conditions currently going on. So the price levels which create support and resistance in a stock only tell half the story. We mentioned a key phrase above, overwhelmingly high. Volume is the second half of the equation and shows us the strength behind the selling and the buying at support and resistance. So that's why I mentioned on Wednesday, when it got down to 62, you had lots of buyers coming in the market. So you had volume jumping up. So that was a big support. That seller or that auctioneer isn't going below 62. He has lots of buyers up there. He had little buyers up at 62.05, little buyers 62.010. He had one buyer 62.50. But $62 became a significant point from now, but it also gives you the point moving into the future. Because what happens is that buyer goes home and he sees his neighbor over the weekend at the farm dance, and mayor says, I hear you bought some new head of cattle. He says, yeah, I did. He says, I think I got a pretty good price. I got $62, 62 cents. Well, now that neighbor is going to go to the auction next week, and he's stuck at that support level at $62. So no matter where that auctioneer starts out, as long as it's above $62, he's not interested because he knows that heads will go to $62 because he saw last week's support levels. Now he's hoping it does, but guess what? There was less cattle that came in this week. So the guy starts out at 62.50, goes to 62.25 and gets some buyers. He's not going back to that 62 level. But Tuesday he goes back and gets some more buyers, 62.25. But you're still holding tight. You don't need to go home until Friday, and you're not really that hot on buying some cattle. If you can't get the right price, you're going to buy. So you're going to sit back and wait for $62. So 62 cents. So if by Friday he's got some cattle left, and there's very few buyers because they all cut that last train home, he may drop to $62 and you grab up your buy and you buy up the last heads and you head on home. Okay. So that $62 becomes a self-fulfilling fantasy also. So support and resistance can come in many forms. And increasing popular techniques to determine support and resistance can be derived through the use of Fibonacci levels. These levels are viewed by some as imaginary levels, but have now developed a strong significance due to their widespread use. Again, Fibonacci levels are sometimes self-fulfilling prophecies. It is almost a self-fulfilling prophecy that causes prices to stop and reverse at these levels. Now, indicators are a great addition when looking at support and resistance levels. This is because indicators will act as another form of validation that a security is reaching a support or resistance level. Since support and resistance levels act in cylindrical fashion, meaning the price will bounce off the high and the low of the range, oscillators fit in very, very well. Oscillators, like support and resistance levels, will bounce from one extreme to the next. So we have many good ones like RSI and stochastics. These are ones that are what called bounded indicators, and they form in a family called oscillators because they report between a number and 0 and 100. When a number's over 70 or under 30, it tells you something about the markets. So remember, support and resistance levels only give you some clues. You need to combine it with other pieces of information. So the other thing you have to remember is support can become resistance, because 62 for the cattle was an important price. Now, when the market reverses and the prices are falling down, say the next Monday, is a beautiful week. You had lots of herds of cattle come. In fact, you have an overabundance of them. So you start at 62 and there's no buyers. You go to 61.75 where you haven't been in weeks, still no buyers. 61.50, there's no buyers. 61.25, and you get a couple buyers. Why? Because you have an overabundance. The market's now turned to a downtrend. So what happens is you're going to move back up towards that 62 level, and the price is going to bounce off of that 62 level. Now became your resistance level because it was your support level, but it becomes the opposite as price moves in the other direction. Okay. So in other words, when you see price coming down, bouncing off the level, moving back up, bouncing off the level, moving back down, now you see it broke through. So this price line right here was supporting the price above here, but later price fell below it, and what did it came up and bounced off it, so it became resistance. Then when price moved up the other way, it became your new support level. Okay. So it becomes, especially when it's a key important level that's been seen a lot. So let's talk about some ways that we can use these, and then we're going to go over and look at some live charts and see what it looks like on a real chart. But tips for using support and resistance levels. You can watch for breakouts. As we noted before, price can and do cross their support and resistance levels on the way to forming new trend lines. Use the current level as guides, but realize that they will change over time. Think of the changes as opportunities to make prices, to make profit. So when you see price bounce up to an old support level and bounce off of it, it might be giving you an opportunity. When you see it return to that and you see many hits off that price becomes, like I said, important. So when you see that happening, okay, you could then determine to enter the market. So like here, finally, we saw that this 165 level was very, very important over a time period. So now it becomes a very hardcore support level. So when we see price fall down the support level, we might want to realize that resistance flipped into support, and we might want to buy going up in that position. Again, here, when we saw this hit the first time, come back down the bottom, we might want to consider at this level selling down into that downward movement. Okay. But there is no rule that it can't break that support and resistance level. But those support and resistance levels, prices don't usually just, yes, if there's weird market things, there's economic events, prices can sometimes soar right through, but most time they will congest at that level and then bounce off and then break through. So when charting the price action of an asset, expect to see at least 2 bounces before considering a given high or low to be a resistance or support level. Preferably, you will see 3 bounces, and each one strengthens the signal. Asset prices tend to test support and resistance levels without breaking through them. You'll likely become nervous when this happens. It's normal. Calm your nerves, learn to trust your charts. When a breakout occurs, it usually does so in the context of forming a new price trend. Your chart should give you a heads up about that in advance, especially if you're looking for specific chart patterns or you're using other indicators. Because if you understand that price bounces off of the support and resistance level, you'll stop panicking because you'll see price hit that resistance level and then come back down to support level. It will help you determine whether you're looking at a retracement or a price reversal. But don't get lazy with your charts. The more you trade a particular asset, the more you'll feel as if you know how its price will move. Be warned, especially in binary options, have a way of surprising even the most experienced trader. Intuition is important, but tracking price action, keeping accurate charts, and collecting reliable data is more important. If any of the above concepts seem complex or confusing, don't worry about it. With time, you'll find that they're actually quite simple to understand, and most of the complexity is due to the lack of familiarity. So let's talk about my favorite thing. And this is my first step, and we call it eyeballing. Because technical analysis isn't an exact science, it is useful to create support and resistance zones. Each security has its own characteristics, and analysis should reflect these intricacies in a security. Sometimes exact support and resistance levels are best, and sometimes zones work better. Generally, the tighter the range, the more exact the level. If the trading range spans less than 2 months and the price range is relatively tight, then the more exact support and resistance levels are best suited. So eyeballing is a matter of looking at current price charts and seeing or identifying key levels that the price has touched before. So let me pop up a chart here for you, a live chart. And we're going to be looking at the Euro US dollar as soon as it pops up on your screen. Okay. Now, because you're looking at somebody else's chart, and this is my chart. I've been using the Euro US dollar for class for the last couple of weeks, and I've been building onto this chart with support and resistance and trend lines as the class has moved along. Now, the colors mean something to me, but they mean absolutely nothing to you. But as we saw the euro trading not so long ago in this price zone, we could establish these support and resistance levels. And you can bring them as far forward as you want. They have no value in today's marketplace because the euro's climbed steadily in an uptrend. But you can keep them on your chart as long as you want, because when the euro is coming down again, and if it drops that low, they might have some significance in the near short-term future. In the longer-term future, the euro is eventually going to get down here anyway, and they could be important. Last week, we established an uptrend for the euro right here, and we actually got 3 or 4 actually support points here. So that gave us a very good uptrend, and we could have projected that forward. But what happened was the euro eased down. That killed this trend line, okay, the end of last week. Now, since this was our bottom, our swing low here, we needed to establish a new trend line, and that trend line has not been validated yet because we don't have 3 points in common yet, but this would have been the proper trend line to project forward. Let's remember, price cannot have broken through a trend line. Now, it happens to be that this gives us a very pretty trend line. Why? Because what do we see? Price thrusts up, eases down, thrusts up, eases down, thrusts up, eases down, thrusts up, and we're down in the ease down now. This is exactly how price should move. Okay. Now we're looking at a 1-hour chart. So this chart's spanning, this trend line is spanning over about a week and a half of trading. But this is exactly what you would expect in an uptrend. Push, ease, push, ease, push, ease. Now, we also were able to create, over the last day or two, a short-term downtrend. Beautiful short-term downtrend that held. It's no longer valid because we see price, some high just popped above that. Okay, I don't know what happened, but the price, the trend line I had drawn on the charts before we started class. Now, we still have our longer-term uptrend. We violated our short-term downtrend, but look at what happened. See this purple line right here? this dashed purple line, I put that on also way before class. Now, this dashed purple line was a support line I had established by going back and looking at these charts to see what price in the near-term future had been important. I then put this trend line, projected it forward, and look at where that high bounced up to. It bounced up to that uptrend and bounced right back off of it. Okay. Now, we expect it to, because I also established the other purple trend line, price line, support line here by eyeballing, and that price trend has now, these two trend lines, these two support and resistance lines have really isolated our price movement. So we could have predicted that price movement fairly accurately when it bounced off of this support line and started moving up. We could have seen that this would have been, we should have expected this to be a top. Now, because it wasn't able to break that top and it wasn't able to sustain that, it went back and returned to its downtrend. But it gave us some understanding of price movement if we had been watching the charts instead of talking in class. Now you want to know, how did I get that? Okay. So how did I get that? I got it using what I call eyeballing, or what we call eyeballing. Eyeballing is simply identifying price that has been important to the markets in previous times that traders have traded near this price. Now, the euro hasn't been this high in quite some time. So all I did was take this chart and I changed it from a one hour chart to a 1 day chart. You could use a 4-day chart. All I'm trying to do is find when price was at this level before. Once I did this, I was able to look and see the dash line. I was able to establish all of these important prices, all of these open and closes, when I was able to drop a line straight across there, and that was the dash line. I was able to take the next line of importance, and that's my solid purple line, and here we had closes at that price. We had opens at that price. We had closes at that price. Then moving forward to the next month, look at all the congestion at that price. Here we have more congestion, and this is on a 1 day chart, so this is covering a year. But look at how important all that price was. Now, there's been nothing near that since this year, so I was able to draw this line, and then I also needed to draw a line higher than where this asset is. So if I look back at October of last year, when the last time the euro was trading, I found a beautiful top here in this range. I found tops here, tops here. I found closes and bottoms here. Okay, and then here I found lots of congestion, lots of trading at that price level. And if I looked at volume along with that at those specific times, that was very important. It's crucially important. So therefore, I was able to project one line, two lines, and a top line here. Then I eyeballed them. That's all I did was eyeball. I then went over and went back to my 1 hour chart, because now they were projected all the way forward into my chart. And there I go. I've got my support and resistance levels for my current trading. So I combine that with my trend line, and this tells me together with when I had this short-term trend was a valid trend line before this bump up here. This long-term uptrend was good. The support line was good. I had a very significant price, or I expected the market to do something at that 118.03, 111.80.03. And look at what I got. Look at all the trading I got bouncing off of that 111.80.03. Yes, I had this freak breakout, but the price went back into this beautiful triangle, actually. And I was able to interpret price, not make a trade. I was able to start interpreting what I can expect with price. And that's all you're doing with support and resistance. Now, I was also able to drop on a second level by taking my downtrend here to my swing low down here to the swing high up here, which was the end of this uptrend. I was able to pull my Fibonacci levels on here, and you can see those right here, the red level here, the brown level here, the 50 level here, the 61.8, and also look at how much price reacted to that Fibonacci level. So we had it touch our support level here. Then when we had the Fibonacci support level, look at how many times the price fell down through this purple support level and hit that Fibonacci level and bounced off of it. So now we've got two sets of important data, and if we combine that, we can see volume down here also telling us a story about price movement. Now at this point, I don't have any additional indicators on here, but all I've done is done some basic information. Nothing complicated, nothing complex, nothing that's going to take you years to master, because this isn't strategy. This is discovering the personality and understanding the price movement and what price is doing at the moment and where price might be expected to act and react. Okay? That's all we're trying to do. If you can interpret what's going to happen there and know that you can expect something to happen, what's going to happen, we don't know, but we can expect something to happen at those levels, you can then start interpreting the markets. So it's not that complex, it's not that scary. And you're not making a trading decision, you're just getting yourself data and knowledge. You're getting yourself smart. So let's go back over to my PowerPoint and let's talk a little bit more about this important stuff here. So another great way to find support and resistance levels is to mark levels in the past where price had a difficult time breaking through, just as we did. As price moves up and down, each level that price has bounced off of could be a level in the future that price bounces off of again. This is a manually intensive method, and it takes time to draw on all the currency pairs that we trade, but can pay off in the long run. Because locating swing lows and swing highs isn't all that difficult. So we've already gone over the chart, because what we expect as price moves up, we expect, because it doesn't move in one straight level, but see here, we have all this congestion at that price. That price then becomes a key level to watch for shorts when it's coming down. We got it up to the swing high. Okay, we're able to put a trend line on there. Came down, bounced back up, bounced off. Came back up to that trend. That trend line bounced off of it again. And where did it come back down to? Where did it stop when it bounced down? It stopped at that important short level. When it did, it broke through there and it gave us a very good short entry. Came back up, bounced off of that support level again. And look at this trade. We could have gotten a very nice trade in here, and it came down to the Fibonacci level at 38.20%. But we're not sure that's where it's going to stop. But that's a point where we might have set our target to exit the market. So as it bounced off of this support resistance level, we could have watched very closely at our support levels from our Fibonacci's and not determined to exit the market, but watch to see what would happen, to see if we should exit the market. Okay, and we could have kept moving our take profit level farther and farther down, so we could have stayed in the market all of that time. But these are part of trading strategies or actual trading as opposed to gathering knowledge. Now, the more time that price bounces off support or falls back from resistance, the stronger these support and resistance levels become. It creates a self-fulfilling prophecy. The more often it happens, the more likely it's to happen again. Now, understanding the concept of support and resistance, trading ranges, breakouts, breakdowns can be very valuable to all traders. Support and resistance is one of the strongest, most dependable tools. And remember this word, tools, available to a trader, not strategies, but tools. And that's why I say volume, trend lines, and support and resistance line are tools that need to be in your toolbox, like your hammer and nails, because you can't start a job until you have the tools and know how to use those basic tools so that you can start building from the basic building blocks. Remember that it's best to use any tool along with other indicators when deciding whether or when to take or exit a position. Support and resistance analysis is often part of trends because it is used to make trading decisions and identify when a trend is reversing. For example, if a trader identifies an important level of resistance that has been tested several times but never broken, he or she may decide to take profits as the share price moves towards this point because it's unlikely that it will move past that level. Now also remember, whole numbers become psychological support and resistance levels. So even though you might look at gold and see that gold at $1,200.05 is the resistance level, 1,200 is a key psychological level because people don't talk about numbers in all the way out digits. They round the euro to say it's trading at 112, or they might say it's trading at 111.80, but they don't really go into 111.82.7. And when they set their stop losses and take profit points, unless you're using computerized trading, most traders will set them if it's 111.84, 111.80.07, they're probably going to set it at 111.80 or 111.81. So the whole numbers become very important. Now there's also another way to get support and resistance levels. I don't like it as much because it's a mathematical calculation, but it's called pivot points. And pivot points come from a chart. And you can get these charts free of charge all over the place. You're available on the MT4 platform. They're available from FX Empire, investing.com, anywhere you can find technical analysis. And what they do is they use mathematical calculations of the high, the low, the open, the close that the price is currently trading at. And they do this calculation with a pivot point calculator that gives you the support and resistance levels above and below the current price level. And they're adjusted by time. So if you're looking at a 1 hour chart, you look at the pivot points for 1 hour. If you're looking at a 15-minute, you look at, and the calculations slightly vary. They help you, give you a heads up. But I much prefer eyeballing and then Fibonacci's before I prefer pivot points. But because I said I use 3 levels of support and resistance, you can combine pivot point charts to give you these levels, or I much prefer GAN fans. And next week we have a class on GAN fans, because GAN fans give you a unique look at support and resistance levels because they also help project price into the future. And GAN fans are a very good indicator that can be used. But most experienced traders will tell you all kinds of stories about how certain price levels tend to prevent traders from pushing price of an underlying asset above or below. Determining future levels of support can drastically improve the returns on short-term investing strategies because it gives traders an accurate picture of what price level should prop up price of any given security in the event of a correction. Now, there are some guidelines or some basic rules. Support and resistance often act as decisive trend changers. If support is violated, that same level will act as a future resistance level. The more often trend lines are tested, the more valid it becomes. So we can see here that 32.50 was a significant price for this asset. Every time it got near to 32.50, it reacted either up or down. So if you were in the market and looking to sell, you might sell the next time it hit that 32.50 because it's probably not going to break through it. If you had bought into the market and the price was moving up, you would want to put your take profit at that 32.50 level because there's very little chance it's going to just break through it without some other substantial point to push it. You should always look at volume to support your decisions because you can see every time the price came up to that support level or the resistance level, volume also spiked. And then lastly, time matters. A lot of times assets move in price ranges where they haven't been in quite some time. When you're looking at, especially when you're eyeballing, you're looking at support and resistance, sometimes you have to go back 6 months, a year, 2 years, 3 years ago to find price at that level. The older that price is, or the longer it's been since it hit it, the less valid that price, that support line is. They still are valid, but the less strength they have. So if you see, as you draw your support line or your resistance line forward, other congestion in a more short term, the more valid they are. When you see that, when something has happened to markets, if gold soared all the way up to $1,400 today and you're looking to find support level for $1,400 and you have to go back to 2 years ago, that's where you have to go, unfortunately. But it's not telling you the markets will necessarily react the same today, but that's where you have to go. So in conclusion, support and resistance levels are key mile markers in a security's progress. Whenever you're developing trading strategies, consider these points on a graph. Doing so will help set profit targets and prevent frustration when eventual reversals occur. So add this to your toolbox of knowledge. And as you add your toolbox and put these tools together, like I said, no matter what you use to trade from, volume, support and resistance, and trend lines are the three basic tools that you should be using or carrying around with you at all times. Okay. And on that note, I'll say goodnight to you. I'll see you on Sunday, and have a very good trading weekend. Thank you for being part of the ETX family. Have a good evening now. Bye.